Did you know you can rent your building to your own business and legally use depreciation to offset your business income? But guess what? There's a catch. If you do it wrong, your losses will get trapped as passive and you won't be able to use them. What I'm going to do in this video is show you how you can make sure you're tapping into those losses to offset your business income. And at the end, I'm going to show you some problems with some specific states that you need to watch out for when using this strategy. All right, let's get started. Okay, so what is the setup? Now, before I go into the tax side of this strategy, I want you to understand the legal setup you should have in place just to make sure you have some asset protection. So when we talk about leasing our property, a commercial property to our business, what I'm implying is this. You've got your business over here. Now, this is going to be either an LLC or Inc., and it's either going to be taxed as an S or C corporation for federal tax purposes. Now, this is your business. You never want to put your property into your business. You always want to keep the property separate, because if you were to place a building or something inside of this business, then A, the strategy I'm about to share with you isn't going to really benefit you. And B, if something were to happen with the business, then you've just lost that real estate asset. And it's a common mistake. I've run across this many times in my practice where people will have S corporations and their CPA advised them when they thought about buying a piece of real estate to run their business out of, to buy it in the name of the company. That is bad advice. So here's what we need to do then. We need to set up a separate LLC over here, and this LLC is going to hold our building, or maybe it's a rental, maybe it's just a house. You're running your business out of a house. Okay, whatever it is, you're going to have a separate company over here, and now you're going to lease the business, lease the property back to the business. So this way we keep things separate. And it's what's required in order to use the strategy I'm about to share with you. Because in this case here, I own the business and I'm going to own my limited liability company that holds title to the property. Now you can definitely use the anonymity stack that I talk about in all of my videos, basically, where with the Wyoming LLC down here, owning this LLC, and then you're down here owning the Wyoming LLC. That works as well. It's not going to impact what I'm about to share with you. I just want you to understand how this works. Okay, so what are we getting at here? So let's say we have a situation where this individual here, his name's Les, we'll call him Les White. All right, so Les White has a business. He's a consultant. And he's been running this business, and now he decides, hey, I'm going to buy a piece of property and I'm going to open up shop in my own property. So he buys a building like this and he decides, hey, I'm going to rent my building to my business. So what Les ends up doing is he ends up setting a fair market rate of rent that he feels is fair. So let's assume he decides to pay this business $5,000 a month. So he ends up generating on that $60K a year. So the business is paying $60K. So think about these numbers for a minute here. Les is out there, he's bringing in money. Let's say he generates $200,000 in income for the business. Okay, we have rental payment of $60,000. That's a deduction. So he has $140,000 of income before we even factor in all the other business expenses, or Les paying himself a salary for working for his business. So that $60K gets paid over to his LLC. Now, because this is Les's LLC, Les down here, he's going to have to recognize this as income to himself. Now, the thing about when you rent property to your own business, you need to be aware of is that this is non-passive income, all right, that gets paid over there. And so that's important because the losses from your real estate still remain passive. It's just this weird thing that the Internal Revenue Code has when you're renting property to your own business. The income's non-passive, but the losses are passive, generally speaking. Now, why is that important? Well, because if Les makes $60K on his rental income, obviously we want to figure out a way to reduce taxes on that $60,000. And so one strategy, of course, Les should consider employing is running a cost seg study on that property. So let's assume Les runs a cost segregation study on his property, and that property, when we're all done with it, it shows that we have property that we can accelerate the depreciation on, which means speed up your tax deductions. We have projected losses of $180,000, okay? So what's going to happen with Les's tax return? on this asset right here? Well, he has $60,000 in income and he has $180,000 in losses. So Les is able to wipe out the taxable or taxes on that 60K because he has more losses than he has income. So that's going to show that he's going to have a $120,000 loss remaining from that property. Now here's where the problem comes in. You see, this loss that he has, Les can't take the $120,000 loss and use it to offset the $140,000 in income in his business. Because as I stated, the loss is passive to him. So he cannot use that against his active income. So where could he use the loss? Well, maybe if Les is an avid real estate investor and he has a lot of rental property, and has a lot of income being generated from that rental property, yeah, he could use the loss to offset other forms of passive income. But in my experience, many times that's not the case. People just don't have that type of passive income because those assets themselves are creating deductions for them. And so they're reducing their income down based upon the depreciation on those other assets. So this becomes trapped. And it's something that Les cannot benefit from. So the rule or the strategy now is to unlock this. And this is what you need to do if you're in this situation. You need to get with a CPA who understands what we call the self-charge rental rule. And the self-charge rental rule, what you're essentially doing is you elect on your tax return to treat this as one economic unit. You make an election to treat it as one economic unit. Now, in order for that to be considered one economic unit, you have to have the same ownership here. Now, if you make that election to treat this as one economic unit, then you're able to free up these losses right here and do exactly what I just told you you couldn't do. And this is something that we see a lot here within our tax department when we're working with small business owners who are leasing property they own to their business, that their prior preparer did not catch this. And what's happening is they have losses building up here and they have taxable income building up here, and they're not maximizing the overall benefit of utilizing this rule because those losses can't be spread out against that active income. So it's really simple. If you do what I just described, you can free up those losses through the self-charge rental rule. You just have to treat them as one common business unit, like I just described, and that'll free it up. Great. So your takeaway should be this. Hey, I got to make sure if I'm leasing property, my CPA is documenting this right. Now, here's the problem at the same time. You see, when you do that strategy that I just shared with you, all right, we've got the $140,000 in income over here, okay, coming in from this property, and I have the $120,000 loss over here, and I'm using it to offset this, so my taxable income for the year is only $20K, not $140,000. The issue for you is that there are specific states. I'm just going to pick on my favorite, which is California. All right, California, when it comes to state income taxes for business owners, does not allow you to recognize this loss against your income. So in California, they do not conform to the federal rule. So what they're going to say is, oh, for California state income tax purposes, you made $140,000. You're like, well, no, I didn't. My business rented it to there and I used the depreciation to offset that. They don't conform to that. So they're still going to tax you on the $140,000. So you get the federal benefit, but you don't receive the state benefit. So what do you do if you're in California or one of those other states that do not conform to the federal law? Typically, they're blue states. Here's what you need to do then. Remember I said we set the rent between these two businesses? Okay, between his active business and this one. What did I say? I said we set it at $60K. Well, the way you're going to be able to reduce state income on this deal here is by actually increasing the rent you're paying over to this business right here. So now maybe what I'm going to do is I'm going to enter into a quadruple-net lease. And I'm going to increase this overall payment as well to $90,000. So now I have my business picking up everything and I've upped the rent as well at the same time. So all of the expenses for, of course, taxes and insurance or maintenance are being paid out of my business over here, and I am increasing my income over here to $90,000 on this side. So what it's effectively doing for me is to lower my taxable income here. Just based upon that strategy there, you might be able to knock this $140,000 down to, say, $90,000 in taxable income for California state purposes versus the 140. Now, does this make sense? Well, it all depends on doing the math, all right? How you make these numbers work. Now, in my case, it probably is not going to make sense because the federal tax savings is going to eclipse the additional taxes you'd have to pay in California by not conforming, but it's something to be aware of. And this is what happens a lot of times when it comes to tax planning, is that most people work with preparers and they're not working with strategists. Strategists are going to identify the issue like I just shared with you, and then look for a way to balance this out and determine what is the optimal situation. So in this case, it's going to be a combination, right? What I would have done in that, what I just shared with you, increase the rent, go for a quadruple or net lease, same time still do the self-charge rental rule. You get the benefit of paying the higher rent over to the LLC to lower your state income tax, and you still get the federal benefit of offsetting it. So these are things you need to look at when it comes to planning. This is what we can help you with here at Anderson. If you'd like to learn more, if you go into the show notes, there is a link. You can set up a strategy session with one of our professionals here at Anderson, and we can help you put together a plan like I just shared with you to make sure you're supercharging your deductions for 2025 and into the future before it's too late. We got a little bit of runway left. Let's take advantage of it together, and we can show you what we can do to help reduce your tax bill. Take care.